If you're an incorporated business owner, you might be paying tens of thousands of dollars in tax more than you need to. You might not even know it. In fact, if you're taking a paycheck the same way every single year without looking whether it should be salary, dividends, or a mix of both, you're probably leaving between $10,000 and $30,000 on the table annually. This video is about the salary versus dividend trap and how to fix it. So here's what you'll learn in the next few minutes. Why many business owners default to the wrong pay structure, and how the Canadian tax system actually allows you to layer these things together that allows you to save some serious money. And I'll also go through a real case study of a Canadian business owner who added $22,000 to his bottom line just by changing the way he paid himself without having to work a single extra hour. I'm Quentin Chambers. I'm a financial planner and portfolio manager. And in my day job, I build total wealth plans and manage portfolios for business owners, incorporated professionals, and affluent Canadians. After a decade of doing this work, one thing is clear. People are leaving serious money on the table. And on this channel, I show you where to look. So here's reality. Many business owners fall into one of two camps. Camp one is you pay yourself entirely through salary. You think it's safer for business purposes, or you want to maximize your RRSP room, or you just follow on what your accountant set up years ago without actually revisiting it. And then we have camp two, which is paying yourself entirely through dividends, because you read somewhere that it avoids CPP contributions and you want to keep more of your money inside of your corporation. So what's the trap? It's that either of these approaches might be completely wrong for your situation. In fact, you're almost guaranteed to be worse off than having a design strategy that was built specifically around your lifestyle needs, your tax bracket, and ultimately your long-term retirement goals. The way your mind naturally thinks about this is usually binary. You pick one, you stick with it. The Canadian tax system is actually designed with more flexibility that you can do better. And here's a key piece that most people forget. The optimal mix is almost never the same from one year to the next. What works when you're making $100,000 is going to be different when you're making $300,000 or $400,000, or when you have kids, or even when you're putting those kids through university. Most business owners set this up once and forget about it, and that's the mistake. So let me explain quickly how this works and why it matters. When you take salary out of your corporation gets a tax deduction. The corporation pays less tax, but you personally have to pay income tax on your salary at your respective marginal rate. And you're also making CPP contributions. When you take dividends, the corporation has already paid corporate tax on that income. But when you receive the dividend, you also get a tax credit that's supposed to account for the fact that the corporation has already paid that tax. This is called tax integration. And in theory, the total tax on active business income should be similar whether you take salary or dividends. But the real world is messier. Your marginal rate varies, CPP contributions have a maximum, so if you've hit the max, salary becomes less attractive. Then there's factoring your RSP room, your lifestyle needs, and if you have other sources of income, or if you're thinking about splitting income with your spouse, this changes the calculation completely. And that's why any good accountant will tell you the same thing I'm telling you right now. There's no one-size-fits-all answer. You have to model it annually, and most people just don't. Which brings us to the part that actually saves you money, the modeling piece. So here's what the right approach actually looks like. Once a year, ideally right before your year end, you sit down with your accountant and your wealth advisor. Then you create a full picture of your personal finances and your business situation. You model out what your tax bill would be if you took an entire draw of salary or dividends. And then you test different combinations. Once you review what your capacity to pay you out from your business is relative to what you need to run your personal lifestyle, you can actually model out your income. You model out what your tax bill would look like if you took your entire draw as salary, and then you model out what it would be like if you took it entirely as dividends. And you test different combinations. What you're looking for is a mix that minimizes your total tax, personal plus corporate, while still being able to meet your lifestyle needs while you're building your retirement assets the way you want. So let me give you an example. Say you need $200,000 in after-tax salary per year to live on. Your corporation is making $400,000 in profit before any compensation to you. The question becomes, should you take $200,000 as salary or dividends or some blend? Here's where it gets interesting. What if you took $120,000 as salary and $80,000 as a dividend? Now, you're still getting the benefit of building that RSP room, but you're also managing your marginal rate more effectively. And you're also creating a different personal cash flow pattern. The difference here might be $5,000 to $8,000 in personal tax saved. Over a decade, that's $50,000 to $80,000. Over a career, that's hundreds of thousands of dollars. So I want to walk you through a real situation. I had a client here living in Manitoba. The client owns a construction business. He'd been running his business for about 12 years. He was earning roughly $400,000 a year through his corporation. And for all of those 12 years, he's been paying himself entirely through dividends. Why? Because his accountant had suggested it once, because he liked the idea of avoiding CPP contributions. He figured he paid enough taxes already. But he missed out on one key calculation. By taking only dividends, he wasn't building any RSP room. His corporation was accumulating cash, but because he wasn't generating any room through salary, he had no tax shelter space to move the cash into for retirement. On top of that, starting at age 55 when he retired, he was going to have a very large tax bill because he eventually needed to take out that money to fund his retirement. When we modeled an alternative approach, a 60-40 blend of salaries versus dividend, here's what changed. First, the salary component generated about $18,000 in annual RSP room. This meant he can contribute significantly to his own RSP using corporate funds, which are tax deductible at the corporate level. Second, because he was lowering his marginal tax rate slightly with the salary component, his overall tax position improved. Third, he was building a proper retirement asset base inside of his RSP, which could be more tax efficient in retirement than holding assets in a corporation. The bottom line, by switching to a blended approach, he increased his after-tax take-home by approximately $22,000 per year. He was actually making more money while paying less tax, while building a stronger retirement position and not having to work a single extra hour. The only thing that changed was the structure and how he paid himself. And that's the insight that changes this from an accounting question into a real wealth building strategy. So what should you do with this information? First, if you've been paying yourself the same way for more than 2 years without revisiting your strategy, you're probably not optimized. Second is you probably can't do this alone. You'll need both your accountant and your wealth advisor that understands your full financial picture. Your accountant's going to know your corporate tax structure and your tax position. A good financial planner will know your personal goals, your retirement timeline, and your risk tolerance. Neither one has a full picture by themselves. Third is understanding that the answer might surprise you. A lot of business owners assume that their compensation should be all salary or all dividends, when it turns out the real answer might be somewhere in the middle. Or the real answer is different than what it was 3 years ago because your circumstances have changed. Okay, so if you're a business owner and you're earning over $250,000 in your corporation, download my Business Owner Playbook. It's a short checklist of planning levers that quietly decide whether your corporation is working for you. This will help you confirm each one is pulling its weight. Most owners who run through it spot at least one area where they can keep more of what they've built. And walking away knowing your setup is working for you is the whole point. The link is in the description. Now, if you found this video useful, hit the like button or drop a comment with what topic you'd like me to break down next. As always, subscribe to make sure that future videos like this end up in your feed. Until the next one, take care.